Meantime, stocks rallying to record highs. And our next guest says that getting in the way of the current momentum trade is like getting in the way of a bus. Emily Roland is co-chief investment strategist at Manulife John Hancock Investments. Good morning to you. Help us understand this. You think a bus is coming. Well, that's a great thing if you're a bull. The thing Joe and I were talking about, I don't know if you heard in the last segment, is this has become the prevailing view, meaning everybody's gotten quite bullish. When everybody gets quite bullish, gets a little nervous for some of us.
Yeah, well, Andrew, there's still a lot to like right now. Corporate earnings coming in at 12% year over year, twice what was expected. We now have a dovish Fed in the wake of that weaker July jobs report. We've got a solid economy. Yes, there are some cracks forming in the labor market, but we're still in decent shape here. The challenge is that it's hard to get much better than this sentiment-wise. The S&P 500 trading at 22 times forward earnings. That's on 14% earnings growth that analysts are looking for in 2026. The peak was 24 times forward earnings in the late 1990s. So there's still a little bit of room here for multiple expansion, but you've just seen technicals and momentum driving this market. The momentum factor, the best performing by far, up 20%. So while there's a lot to like right now, sentiment to us is pretty stretched.
So you're saying sentiment is stretched. I feel like there's two things going on there. How can sentiment be stretched and the bus is just tearing down the road?
Well, momentum goes up until it doesn't. So it can reverse powerfully, but it can last for some time as well. So you certainly want to be participating in this markets, but we're suggesting that investors trim into the riskiest pockets of the market and redeploy assets into higher quality stocks that have a better ability to maintain their margins in the face of some margin pressure that we expect going forward. Don't just have momentum and technical trends, but also have things like great return on equity. They also have a strong PEG ratio where you're being mindful of how much you're paying for that future earnings growth. So still, again, want to participate, but just want to think about not reaching too far for risk.
Okay, but then what do you do about the Magnificent Seven? Is that on your list? Is it not on your list?
We are overweight. We've been overweight technology stocks in the United States for over 5 years now, and it's because they continue to score high on our quality metrics. Some of the best return on equity you're going to find is within the technology and communication services parts of the market. The only problem with these new all-time highs is one of the side effects has been even more concentration in markets, with the top 10 stocks representing now 40% of the index, the most ever. So, people ask us for our prospects on the markets, and it's like, all right, well, I got to tell you what 10 stocks are going to do. So while we still like that pocket of the market, we want to own things like mid-cap stocks. We want to look for ways to diversify into high-quality areas in other parts of the market. Mid-cap still of our favorites, trading at a 30% discount to the broad market. It's really hard to find stuff that's on sale right now. And that, Andrew, is where we're going.
Why do you think that stuff's on sale? Usually when stuff's on sale, it's on sale for a reason.
Yeah, well, it's trading at average to its 20-year average valuation right now. And one thing that we've noted is that there is a very different sector composition in mid caps, which is helping contain those valuations. There's a big relative sector overweight to areas like industrials that we see benefiting from CapEx in the United States, the one big beautiful bill being very accretive to earnings in the industrial space. And we just don't think that's been picked up yet by investors here.